Joining us right now to talk more about that is Janney Montgomery Scott, Chief Investment Strategist, Mark Luschini. Mark, it's good to see you this morning.
Thank you, Maria.
Thanks so much for joining us. How would you assess markets right here after the volatile week? Would you put new money to work here?
Well, I would. I think that this is simply a correction within an otherwise secular advance that still has further to go. I think the business cycle is still very accommodative, as evidenced by the strength in the U.S. economy. The Atlanta Fed's own GDP Now tracker showing 3.9% GDP growth here so far in the third quarter. And corporate earnings, while decelerating somewhat, are still highly strong. And so as a consequence, I still think that's supportive of equity prices, even after we get past this indigestion of coming to grips with higher interest rates, a Federal Reserve that is hiking rates in trade policy, and throw in a couple other geopolitical matters that, of course, have markets on their heels a bit at the moment. But ultimately, yes.
We got this dig, and we got J.P. Morgan out this morning saying we're going to see a recession in 2 years. We got the Chinese economy seeing the GDP that came in light, 6.5% overnight. Are these issues?
They're issues, and I think that they're certainly already factored into the stock market at these levels. Curious, though, Mark, to ask you, in terms of stock market sectors, what do you avoid here? Is it certain sectors that are still overvalued, more interest rate sensitive? Again, we've already seen a big downdraft in, say, the home builders and autos this year, but what would you not put new money in?
Well, you know, if you look at midterm election cycles, it would tell you that basically what's been leading of recent, which are staples, utilities, healthcare, and telecommunication stocks, are going to be subject to a rotation here subsequent to the post-election couple of months into the first quarter of 2019. So I'd be reluctant to chase those defensive sectors that have seemingly ignored the higher move in interest rates, as they are interest rate sensitive sectors, and instead investors have flocked to as basically a way to go long defense in a market that is volatile at the moment, and otherwise look for those more pro-cyclical sectors to resume their advance here later into the year and into the first quarter of next.
Yeah, Mark, I think you're bringing up a pretty interesting point, because one of the sectors that you actually left out was real estate, and we've seen real estate actually has been completely strong as this market has sold off, and even with rates rising up. And that's because if you look over since 1992, we've seen REITs have actually had a positive total return 87% of the time interest rates go up, and they've outperformed the S&P 500 53% of that time. So where are you positioning in a defensive sector like that with rates going up?
Well, I think, again, I'd probably lump that into the other defensive sectors that they've been bought as bond surrogates. I think ultimately they do respond nicely to a stronger economy, because theoretically many of the operations of real estate investment trusts own properties that they can roll up by way of rents, along with higher interest rates in a stronger economy, but usually with a lag. So I think you might be able to get greater capital appreciation by looking into those sectors that have been more recently taken down, like energy and even some of the software technology stocks that I think will stand to benefit from, one, the idiosyncratic risk associated with higher oil prices and the prospects thereof, and secondly, the fact that business capex is strong and software technology stands to be the disproportionate beneficiary of that spending cycle.
It seems like we're in a cycle where pricing power is going to be incredibly important to who can really do well, who can kind of get through this, any kind of pressures brought by tariffs and so forth. And again, does that inform what sectors you're looking at?
Almost certainly. I think if you have to be careful. If you look at the consumer discretionary sector, that's really masked by the fact that at the end of the day, it's Amazon and just about anything else. But if you look within that sector, there's some industries that aren't performing particularly well. Look at home builders. Home building stocks have been absolutely slayed here, as concerns are overriding what otherwise would be a very strong demographic push relative to household formation, because of higher interest rates and the inability, obviously, of home builders to be able to price on those or add on those price hikes to already elevated new home prices.
So you're not buying this expectation that things slow down in the next 2 years, Mark, and J.P. Morgan's with a 60% probability of recession. Real quick.
I wouldn't say I buy into 2 years, but certainly 2 to 3 years. I mean, I'm not that far off of that, and if only because I think we're late enough in the cycle, and the prospects of higher interest rates could yield to see some deterioration in economic activity. But that's a 2020, 2021 story in my view.
All right, Mark. Great to see you once again. Thanks so much,
Mark.
Mark Luschini joining us there.